China's economy is facing its most serious crisis in decades. What was once the unstoppable engine of global growth is now showing alarming signs of strain. From trade slowdowns to staggering debt levels, the cracks are appearing everywhere, and the world is beginning to take notice. This is not just a problem for Beijing or for Chinese citizens. It is a situation that could ripple across global markets, affecting investments, commodities, and the stability of international trade. Beneath the headlines of modest growth and government reassurances lies a hidden crisis, one that experts fear may be far worse than publicly acknowledged. Imagine the consequences if the second largest economy in the world were to stumble seriously. Factories slowing, exports declining, and financial systems under pressure. How prepared are investors, businesses, and governments for a collapse of this magnitude? The time to understand the truth is now, before the next shock hits. When discussing global economic crises, few voices carry as much weight as Warren Buffett. Often called the Oracle of Omaha, Buffett has spent more than 7 decades observing, analyzing, and investing in markets around the world. He has seen economies rise to unprecedented heights and collapse in spectacular fashion. From the oil shocks of the 1,970 seconds to the dot-com bubble, and most notably the 2008 financial crisis. Buffett has been there studying the patterns, understanding the mistakes, and learning the lessons that history teaches so rarely. His perspective is not built on speculation, social media trends, or fleeting headlines. It is grounded in decades of real-world experience and rigorous analysis of business fundamentals, supply chains, financial systems, and human behavior in times of crisis. This is why Buffett's warnings about China's economy are so significant. When someone with his record of insight and disciplined judgment signals caution, the world should listen. He has consistently demonstrated the ability to separate hype from reality, identifying risks that others overlook and opportunities that others dismiss. Buffett understands the interconnected nature of today's global markets, how the failure or slowdown of one major economy can ripple through investments, trade, and commodities across the planet. Trust in this analysis is essential because the signals we are seeing in China are subtle yet critical. Debt levels, slowing industrial output, declining exports, and the fragility of real estate markets are not merely abstract numbers. They represent vulnerabilities that can have real consequences for economies worldwide. When Buffett assesses these risks, he draws not only on data but on historical precedent. He understands how over-leveraged systems collapse, how consumer and investor confidence can evaporate, and how governments respond when crises reach critical points. By using Warren Buffett as the lens for understanding the current situation in China, we are not relying on fear-mongering or sensationalism. Instead, we are examining the facts through the eyes of someone who has seen history repeat itself countless times. His warnings carry credibility because they are informed by experience, economic literacy, and a track record of foresight that very few in the financial world can match. This is not speculation. It is reasoned, careful, and deeply grounded analysis, exactly what the world needs when confronting a potential economic collapse of China's magnitude. China's economy, long regarded as the engine of global growth, is showing signs of severe stress. For decades, China sustained double-digit GDP growth, averaging around 10% per year during the early 2000s. And even after moderating, it consistently grew at rates exceeding 6% annually. Today, in 2025, growth projections hover around 2.5 to 3%, the lowest in decades outside of the pandemic years. To put this in perspective, the United States and the European Union are projected to grow at roughly 1.8 to 2.2%. Yet their economies are far more mature and stable. For a country accustomed to rapid expansion, such a slowdown signals structural weaknesses rather than a temporary soft patch. Debt levels in China have reached alarming proportions. The total debt to GDP ratio now exceeds 300%, including government, municipal, corporate, and shadow banking obligations. Municipalities rely heavily on off-balance sheet financing to fund infrastructure projects, while corporations, particularly in real estate and construction, carry enormous leverage. Shadow banking, which once helped circumvent strict lending regulations, has created hidden liabilities that could destabilize the financial system if defaults rise sharply. Analysts estimate that non-performing loans could exceed $1.2 trillion if the economic slowdown continues. The real estate sector, which has been a pillar of China's growth, is in crisis. Developers continue to default on debt obligations reminiscent of the Evergrande collapse of 2021, leaving millions of apartments unsold and construction projects frozen. Surveys indicate that over 20 million homes are sitting empty, representing not just idle assets, but lost consumer wealth and deferred economic activity. Real estate contributes roughly 25 to 30% of China's GDP when including related industries, meaning continued stagnation here has profound implications for the broader economy. Manufacturing, once the world's workshop, is also slowing. Export growth has declined sharply, dropping nearly 8% year over year in the past quarter alone. Overcapacity in industries such as steel, cement, and electronics creates inefficiencies, while global demand shifts toward Southeast Asia and India as companies diversify supply chains away from China. This manufacturing slowdown undermines employment, reduces corporate profits, and further depresses consumer confidence. Consumer spending, the lifeblood of a modern economy, is constrained by rising living costs and declining purchasing power. Inflation for essentials such as food and energy has increased by 6 to 8% annually, while median wages have stagnated, leaving households with less disposable income. Urban youth unemployment now exceeds 22%, a record high, fueling social tension and eroding confidence in the government's ability to maintain stability. These metrics collectively reveal a fragile economic foundation. Slowing GDP growth reflects structural limits. Ballooning debt signals systemic risk. The real estate collapse threatens wealth and investment. Manufacturing stagnation undermines exports, and consumer strain threatens internal demand. Compared to the United States or the European Union, China's vulnerabilities are amplified by the scale of its population, the opacity of financial reporting, and the intertwined nature of state-owned enterprises and local governments. Taken together, these indicators are not merely statistical anomalies, they are early warning signs. They expose an economy that has relied on debt-fueled growth, overinvestment, and export dependency, now confronting the limits of those strategies. The question is no longer whether China can continue to grow, but how deeply this hidden crisis will reverberate through global trade, investment flows, and financial markets. The fragility of China's current situation makes it one of the most consequential economic stories in decades, one that demands close attention from investors, policymakers, and the public alike. To understand why China's economy is teetering on the edge, one must look beyond the headlines and examine the underlying causes. At the heart of the crisis is a real estate bubble that has grown to a size few outside China fully comprehend. For decades, property development was considered the engine of Chinese growth. Developers borrowed heavily, building vast apartment complexes in entire cities where no one lived. These ghost cities became symbols of ambition, unchecked by economic reality. Evergrande, one of China's largest developers, famously defaulted on over $300 billion of obligations in 2021. But the problem has not disappeared. It has merely spread across other developers. Household debt has surged alongside this speculative frenzy, with mortgages accounting for more than 60% of urban family debt. Many households borrowed beyond their means, expecting property prices to rise indefinitely. The result is an enormous stock of unsold apartments, frozen projects, and families trapped in debt burdens they may never escape. Corporate and government debt compounds the problem. Local governments, under pressure to maintain growth targets, relied on off-balance sheet financing vehicles to fund infrastructure and social projects. These hidden liabilities are enormous, estimated to exceed $5 trillion, and their true risk remains opaque. Shadow banking, once a tool for circumventing strict lending regulations, has created a web of complex, unregulated financial obligations. When defaults begin to cascade, these hidden debts can magnify the impact, destabilizing the broader financial system. Corporate debt, meanwhile, has soared in tandem with property speculation. Companies across manufacturing, construction, and services have leveraged heavily, assuming continued economic expansion. When growth slows, these debts become a ticking time bomb. Manufacturing, the backbone of China's export-driven growth, is now faltering. Export growth has slowed due to global inflation, higher interest rates abroad, and lingering trade tensions. Tariffs and protectionist policies in key markets have made Chinese goods less competitive. At the same time, overproduction has created massive unsold inventories. Factories that once ran around the clock are now facing idle capacity and mounting losses. Steel mills, cement plants, and electronics manufacturers all report lower orders, shrinking profits, and layoffs. This slowdown has ripple effects, reducing corporate tax revenue, limiting government spending, and increasing unemployment in industrial regions. Consumer weakness further aggravates the situation. Despite decades of rising incomes, the Chinese middle class faces mounting pressures. Wages have stagnated in real terms, property prices remain extraordinarily high, and everyday living costs continue to climb. Consumer confidence is falling, reflected in declining retail sales. In 2024 alone, retail consumption grew by only 2%, far below historical averages of 8 to 10%. When households are forced to dedicate larger portions of income to debt service or basic necessities, discretionary spending, the engine of domestic growth, falls dramatically. A shrinking consumer base amplifies the consequences of a slowing real estate and manufacturing sector, creating a vicious cycle of reduced economic activity. Policy missteps have added fuel to the fire. China's strict zero-COVID measures, which lasted intermittently until 2023, disrupted domestic consumption, supply chains, and industrial production. While intended to protect public health, these lockdowns left long-term scars on small businesses and consumer confidence. Further, regulatory crackdowns on the technology and education sectors have slowed innovation, reduced foreign investment, and created uncertainty in capital markets. Investors now face unpredictability. Rules can change overnight, and even profitable companies may find themselves targeted by government action. This regulatory uncertainty discourages private investment, which is essential for sustaining long-term economic growth. Taken together, these causes form a complex web of interrelated vulnerabilities. The real estate bubble and household debt create financial fragility. Corporate and government borrowing amplifies systemic risk. Manufacturing slowdown and export decline remove the economic engine that fueled growth for decades. Weak consumer demand signals that domestic resilience is eroding. Policy missteps compound all of these factors, creating uncertainty and fear. Each of these issues alone might be manageable. Together, they form a perfect storm. The challenge is not merely slowing growth. It is the potential for cascading failures that could reverberate throughout China's financial system and, by extension, the global economy. When the largest components of a nation's GDP are simultaneously under stress, the effects are magnified exponentially. Investors, policymakers, and ordinary citizens alike are watching with a mixture of fear and anticipation. This is not a minor correction. It is a structural crisis with roots in decades of policy, culture, and economic strategy. Understanding these causes is the first step toward appreciating the full magnitude of the challenge ahead. The real estate sector in China is not merely struggling, it is in crisis. This is not a distant problem confined to a few companies. The collapse of major developers has sent shockwaves throughout the economy. Evergrande, once the poster child of China's property boom, defaulted on over $300 billion in debt, leaving creditors, contractors, and homeowners in uncertainty. Country Garden, another colossal developer, has faced liquidity crunches, delayed payments to suppliers, and halted construction projects. These are not isolated incidents. They are emblematic of systemic stress in a market built on over-leverage and relentless expansion. The consequences extend far beyond the balance sheets of these corporations. Banks that lend heavily to property developers face rising non-performing loans, threatening their capital adequacy. When developers cannot meet their obligations, banks tighten lending to other sectors, further constraining economic activity. Households, too, are caught in the middle. Millions of buyers who invested in pre-sold apartments now face incomplete buildings, frozen mortgages, and declining property values. The psychological impact on consumers cannot be overstated. Real estate is more than an investment in China. It is a primary form of wealth and security. When confidence in the sector falters, households cut back on spending, saving for uncertainty rather than consumption. Suppliers, from steel mills to construction firms, are also suffering. Payments that once flowed predictably from developers have slowed or stopped entirely. Materials sit unused in warehouses, equipment remains idle on construction sites, and workers face layoffs. The ripple effect spreads across local economies, reducing incomes and increasing social pressures. Entire communities built around property development, cities, towns, and industrial hubs experience stagnation when construction halts. Perhaps the most visible symbol of the crisis is China's ghost cities. Towering high-rises stand empty, streets remain barren, and shopping centers wait for customers who never arrive. These empty apartments are a stark reminder that ambition and speculation were not always aligned with genuine demand. In many cases, entire cities were constructed on the assumption that the population would grow rapidly and that buyers would continuously invest in real estate. The mismatch between supply and actual need has left a tangible, almost surreal landscape of unused infrastructure, a visual testament to economic misalignment. The domino effect of this real estate crisis is already underway. Consumer confidence is falling, reducing spending in other sectors. Construction demand, which once fueled growth in steel, cement, and logistics, has slowed dramatically. Banks and financial institutions face rising exposure to defaulting developers, increasing the risk of a broader financial instability. The government, while attempting to intervene through selective bailouts and policy adjustments, struggles to balance moral hazard against the need for stability. Every halted project, every defaulted debt, and every unsold apartment adds weight to the economic uncertainty. In essence, the real estate sector is no longer just a contributor to China's GDP. It has become a potential catalyst for systemic weakness. Its collapse impacts households, banks, suppliers, and local economies, creating a web of interconnected vulnerabilities. Just as in other historical bubbles, the visible signs, ghost cities, halted construction, and unpaid debts are accompanied by less visible but equally dangerous strains in confidence, credit, and liquidity. When the foundations of an economy's largest asset class falter, the consequences are far-reaching, touching every corner of society and reverberating globally. The question is no longer whether the real estate sector can recover, it is whether China's broader economy can withstand the cascading effects. As defaults mount and confidence erodes, the crisis extends well beyond developers and into the very fabric of the nation's financial system. This is not merely a correction. It is a structural realignment with profound implications for households, corporations, and policymakers alike. China's mounting debt is more than a statistic. It is a warning sign flashing red across the global financial system. Total debt in China, including government, corporate, and household borrowing, has soared to over 330% of GDP. To put that in perspective, Japan's debt to GDP ratio approached similar levels in the late 1980 seconds, preceding a decades-long period of stagnation. The United States, too, faced dangerous levels of leverage prior to the 2008 financial crisis. History teaches a simple lesson. When debt accumulates faster than growth, the risk of financial instability escalates sharply. A major concern lies in shadow banking. Unlike traditional banks, shadow lenders operate in a gray area, offering loans through off-balance sheet entities and investment products. While these vehicles initially provided liquidity and fuel for growth, they have become opaque, creating hidden liabilities that regulators cannot easily track. When developers fail to repay loans or property values collapse, these obligations surface suddenly, exposing banks and investors to losses they were not prepared to absorb. It is not merely a question of who owes what. It is a question of trust, transparency, and the ability of the financial system to withstand shocks. Potential bank failures are no longer hypothetical. Smaller regional banks, heavily exposed to local government financing vehicles, and over-leveraged developers face rising non-performing loans. Even major institutions are not immune. Liquidity crises could emerge if depositors lose confidence and begin withdrawing funds en masse. A cascade of defaults, coupled with frozen credit lines, could amplify stress across the economy, undermining growth and shaking global markets. Leverage magnifies risk in ways that are often underestimated. When an economy relies heavily on borrowed money, even minor disruptions can snowball into systemic crises. Debt that was once a tool for growth becomes a trap, binding governments, corporations, and households in a web of obligations. Every missed payment, every decline in asset values reverberates through the system, magnifying losses and amplifying fear. China's situation is further complicated by the interconnectedness of its banks, corporations, and local governments. Unlike isolated defaults, the collapse of one entity can trigger a chain reaction across multiple sectors. Confidence, always a fragile component in financial markets, becomes the critical currency. If investors, lenders, or households lose faith in the stability of the system, the resulting panic could be far more damaging than any single default. In essence, the combination of high total debt, shadow banking exposure, and leveraged financial structures creates a precarious environment. It is a system poised on a knife edge, where missteps or shocks could trigger severe economic consequences. Warren Buffett has long emphasized the importance of financial prudence and the dangers of excessive leverage. In China today, those warnings are more relevant than ever, as the nation faces the daunting challenge of balancing growth with stability in a heavily indebted economy. China's economy has long been powered by its manufacturing engine. From electronics to textiles, machinery to consumer goods, China has become the world's factory, producing everything from smartphones to steel beams. This export-driven growth has fueled decades of expansion, lifted millions out of poverty, and positioned China as a central node in global supply chains. Yet today, that very engine shows signs of stalling. Global demand is slowing. Rising inflation in Europe and the United States, coupled with interest rate hikes, has reduced consumer spending on goods imported from China. Meanwhile, geopolitical tensions continue to cast a long shadow over trade. The ongoing U.S.-China trade disputes, tariffs, and export controls on critical technologies have disrupted established channels and created uncertainty for manufacturers. Companies once confident in long-term orders are now hesitant, holding back investment and scaling production cautiously. Overcapacity has emerged as a particularly severe problem. In industries such as steel, solar panels, and consumer electronics, production exceeds global demand. Factories that once ran at full capacity now sit partially idle. Inventories accumulate, and prices are pressured downward. Overproduction is not merely a minor inefficiency. It undermines profitability across the sector, forcing companies to reduce margins, lay off workers, or even shutter facilities. The ripple effects extend far beyond China's borders. Multinational corporations, heavily reliant on Chinese manufacturing, face delays, higher costs, and uncertainty in sourcing critical components. Electronics companies struggle with inconsistent supply of semiconductors and display panels. The automotive sector faces delays in parts, while apparel and consumer goods brands navigate rising input costs and inventory backlogs. The global supply chain, long dependent on China's efficiency, is being forced to adapt, with some firms diversifying to Vietnam, India, or Mexico. This transition, while necessary for risk management, introduces inefficiencies, higher costs, and further strain on international commerce. The slowdown also impacts domestic investment. With factories running below capacity and exports faltering, corporate earnings decline. Companies reduce spending on research, expansion, and hiring. Local governments, previously relying on manufacturing, taxes, and employment, face budget shortfalls. Workers in industrial hubs experience stagnant wages or unemployment, reducing domestic consumption and reinforcing a negative feedback loop that weakens overall economic growth. China's manufacturing and export slowdown is therefore not an isolated issue, it is a systemic warning signal. The nation's global influence, built on decades of industrial dominance, now faces structural challenges. Persistent overcapacity, declining external demand, and geopolitical uncertainty threaten not only corporate profits, but also social stability and long-term economic growth. Warren Buffett has often reminded investors to consider the durability of earnings and the sustainability of business models. In China, the once invincible manufacturing machine is showing cracks that must not be ignored. The health of any economy is not measured solely by factories or stock markets. It is measured by the people who live and spend within it. In China today, the signs of strain are increasingly visible in households across the nation. Urban unemployment, particularly among youth, has reached levels not seen in decades. Official figures place youth unemployment at over 21% in major cities, but economists suggest the true number could be even higher when including those underemployed or working in precarious informal jobs. For a generation that has grown up expecting prosperity, this creates not just financial stress, but a crisis of confidence in the future. The middle class, long considered the engine of domestic consumption, is shrinking. Rising living costs, stagnant wages, and skyrocketing property prices have left families with less disposable income. Where once consumers freely spent on electronics, travel, and entertainment, today many households are tightening belts, delaying major purchases, and prioritizing essential goods. Retail sales growth has slowed sharply, and luxury brands report softer demand as cautious consumers adjust to economic uncertainty. Consumer confidence indices have dropped to multi-year lows, reflecting a broader sentiment of insecurity. Household debt amplifies the problem. Mortgages, credit cards, and personal loans now consume an increasing share of family income, leaving little room for discretionary spending. The real estate crisis, with its ghost cities and stalled projects, has trapped many homeowners in negative equity or exposed them to the risk of default. This financial pressure forces families to prioritize survival over growth, cutting back on consumption that once drove the economy. In Buffett's terms, productive capital has been replaced by financial stress, and the multiplier effect on the broader economy is immediate and tangible. The social consequences of these economic pressures are profound. Rising unemployment and financial insecurity create discontent, particularly among young adults who feel their prospects are limited despite years of education. Social unrest, once contained, could grow if economic stagnation persists. In a society accustomed to rapid growth and upward mobility, frustration with stalled opportunity and inequality can translate into political pressures that test governance and stability. The combination of declining consumer confidence, high debt, and constrained household spending is more than a short-term challenge. It signals structural fragility in the economy. When individuals cannot spend, businesses cannot earn. And when businesses cannot earn, governments cannot collect sufficient revenue without increasing taxes or cutting services. This cascading effect undermines social cohesion and economic resilience. China's domestic economy, long fueled by consumption alongside exports and investment, is showing signs of exhaustion. As Warren Buffett often reminds investors, the true measure of a system's strength lies not in momentary gains, but in sustainable, reliable growth. For China, the warning signs are clear. Unless consumer spending rebounds and social pressures are addressed, the economic and societal implications could be profound and enduring. History has a way of repeating itself, not exactly in detail, but in patterns and consequences. When we examine China's current economic predicament, it is instructive to consider historical analogies that illuminate both the risks and potential outcomes. Warren Buffett has long emphasized that while no two crises are identical, human behavior in markets often follows familiar scripts: greed, fear, overconfidence, and speculation. Consider Japan in the early 1992. At the peak of its real estate bubble, land values in Tokyo reached astronomical levels, often exceeding the combined value of entire regions elsewhere. Banks, corporations, and households borrowed aggressively, expecting prices to rise indefinitely. When the bubble burst, asset prices collapsed, leaving balance sheets insolvent and banks paralyzed. Japan entered what would become known as the lost decade, a prolonged period of stagnation, deflation, and low growth that lasted more than 10 years. The lesson is clear. Over-leveraging in real estate can cripple an economy for decades. Another cautionary tale is the collapse of the Soviet Union in 1991. Years of centralized planning, hidden debts, and inefficient industries masked structural weaknesses. When systemic cracks became irreparable, the economy imploded, wiping out savings, destabilizing entire regions, and triggering profound social and political upheaval. While China's system is not identical, the principle remains. Ignoring structural imbalances and relying on unsustainable growth models can have cascading effects far beyond economics. We can also look to the global financial crisis of 2008. Over-leveraging, opaque financial products, and excessive risk-taking in the housing and banking sectors created a fragile system primed for collapse. When defaults began to rise, confidence evaporated, credit froze, and economies worldwide plunged into recession. The aftermath revealed a fundamental truth. Even sophisticated institutions can miscalculate risk, and interconnected systems transmit shocks rapidly across the globe. China today exhibits echoes of these historical lessons. Over-leveraged real estate developers, mounting corporate debt, and a banking system stretched to the limit mirror the warning signs seen in Japan in 2008. Social pressures, urban unemployment, and slowing consumption reflect vulnerabilities that were present in both Japan and the Soviet Union before crises became unavoidable. Buffett often stresses that understanding history does not guarantee foresight, but it equips investors to recognize patterns and prepare for possibilities. Markets and economies may innovate, but human behavior, fear, speculation, and herd mentality remains remarkably consistent. By studying past collapses, we can see the potential consequences of ignoring warning signs, relying on unsustainable growth, and underestimating the ripple effects of financial stress. In short, history teaches us that economic collapses are rarely sudden or isolated. They are processes that unfold over years, marked by warning signals and structural weaknesses. China's current trajectory contains familiar markers, and the lessons of the past are not merely academic. They are urgent reminders for investors, policymakers, and citizens alike. China is not just a domestic powerhouse. It is a cornerstone of the global economy. When China falters, the tremors are felt across continents, affecting markets, trade, and investment portfolios worldwide. Warren Buffett often reminds investors that the world is interconnected. No economy operates in isolation, and China's current economic stress carries implications far beyond its borders. Commodity markets are among the first to react. China consumes a significant portion of global steel, copper, and oil. A slowdown in construction, manufacturing, and industrial activity reduces demand for these resources, leading to falling prices and disrupted markets. Countries dependent on exports to China, from Australia to Brazil, face declining revenues, threatening growth and fiscal stability. Equity markets are also highly sensitive. Multinational corporations, particularly in technology, automotive, and consumer goods, rely heavily on Chinese production, sales, and supply chains. Any disruption in China's manufacturing capacity reverberates through quarterly earnings reports and investor sentiment. Companies may experience inventory bottlenecks, rising production costs, and delayed product launches, eroding profitability. Investors in the United States and Europe, even those who do not own Chinese assets directly, are exposed through these global corporate linkages. Currency fluctuations add another layer of risk. A weakening yuan can ripple through currency markets, affecting exchange rates, capital flows, and international trade agreements. Hedge funds, institutional investors, and sovereign wealth funds holding Chinese debt or equities must navigate increased volatility, while emerging markets that have borrowed in dollars or rely on Chinese trade face heightened financial stress. Beyond economics, there are geopolitical consequences. A struggling Chinese economy may alter the balance of power in Asia and globally. Resource competition, regional alliances, and trade negotiations could be reshaped as Beijing prioritizes domestic stability over international engagement. Tensions with the United States, the European Union, and neighboring countries may intensify, impacting global security, trade policies, and diplomatic relations. Buffett often emphasizes that investors should think in decades, not quarters. Understanding the global consequences of China's economic stress is essential for strategic planning. The risks extend beyond temporary market volatility. They encompass supply chain disruptions, investment recalibrations, and broader geopolitical shifts. In a world increasingly dependent on China for production and consumption, a domestic crisis is inherently an international concern. In short, the collapse of China's economy is not a local story. It is a global event in slow motion. Every investor, policymaker, and business leader with exposure to Chinese markets must recognize the cascading effects, plan for uncertainty, and appreciate the scale of potential disruption that extends from commodities to currencies, from boardrooms to capitals. Imagine for a moment that you are given a choice. You have $100,000 to invest. On one side, you can put it into Chinese real estate, shadow bank corporations, and heavily indebted municipal projects. On the other, you can invest in a diversified portfolio of productive businesses, companies that manufacture goods, provide essential services, and generate consistent cash flow year after year. Which choice would offer true long-term security? Which choice would allow you to sleep peacefully at night? Warren Buffett has long taught that the fundamental rule of investing is to buy productive assets. He does not chase speculation, excitement, or the promise of massive short-term gains. China's current economic situation, with sky-high debt ratios, declining consumer confidence, and faltering industries, represents the very type of speculative bubble he warns against. The numbers are staggering. Total debt exceeds 300% of GDP. Household and corporate leverage are soaring, and local governments carry hidden liabilities that could ignite a banking crisis. The risk is not abstract. It is measurable and tangible. Now consider the opportunity cost. If you allocate capital to a system teetering under unsustainable debt, you are not just risking a loss, you are foregoing years of potential growth in productive assets. Businesses that pay dividends, reinvest profits, and expand operations generate wealth consistently. A factory producing goods that people need every day will continue to create value regardless of sentiment or market hype. China's debt-laden economy, in contrast, produces nothing tangible for its investors. It is a vast construct reliant on confidence, speculation, and hope that the next buyer will pay more than the previous one. Ask yourself this: if China's economy collapses further, who bears the cost? Banks, investors, households, and even foreign governments are exposed. How would you feel if your wealth depended entirely on hope rather than productive output? Could you tolerate the volatility, the uncertainty, and the domino effects of defaults and financial instability? Buffett often reminds investors that the simplest questions reveal the most profound truths. Investing is not about catching the next boom. It is about understanding value. The Chinese economy may recover, but at what cost? Are the potential rewards worth the systemic risks, the debt overhang, and the social upheaval that may follow? In short, a thoughtful, Buffett-style analysis emphasizes clarity over hype, patience over panic, and value over speculation. When faced with a crisis of this magnitude, the wisest course is to invest in what truly produces value: companies, farms, and assets that generate consistent wealth rather than gambling on the fragile promise of an economy built on debt and speculation. The questions are uncomfortable, but the answers determine whether your wealth survives or disappears. When faced with the potential collapse of a major economy, the question is not only what is happening, but what you should do about it. The first and most important principle is diversification. Never place all of your capital in a single country, sector, or asset class. China, with its mounting debt, unstable property market, and faltering consumer demand, is high-risk territory. Exposure is inevitable for global investors, but overconcentration is dangerous. Spread your investments across productive businesses, stable economies, and asset classes that generate consistent returns. Next, consider hedging against currency and market risks. Economic instability often triggers currency fluctuations, affecting international holdings and trade-dependent investments. Thoughtful allocation in foreign currencies, bonds, or assets with low correlation to volatile markets can mitigate potential losses. This is not speculation, it is prudence. Seek alternative growth markets or undervalued sectors. Emerging economies with solid fundamentals, businesses with tangible outputs, or industries with sustainable competitive advantages often provide opportunities without the speculative frenzy that dominates distressed economies. The key is to invest in entities that create real value goods, services, and cash flow rather than chasing headlines or hype. Long-term, principle-based investing remains the most reliable path to wealth accumulation. Patience and discipline are not glamorous, but they protect your capital while compounding growth steadily. Avoid impulsive decisions driven by fear or greed. History demonstrates that markets recover and innovate, but speculative bubbles often inflict lasting damage on those who ignore fundamentals. Finally, maintain a clear understanding of risk. Do not gamble on hope or rely on promises of outsized returns from fragile systems. Ask yourself, if a portion of your wealth were lost tomorrow, would it endanger your retirement, your family's future, or your ability to pursue your goals? Investing should enhance financial security, not threaten it. In summary, the actionable guidance is straightforward. Diversify wisely, hedge appropriately, seek productive opportunities, remain disciplined, and always respect risk. In the face of uncertainty in China's economy or any high-risk environment, these principles are your safeguard. Wealth is built over time on the foundations of value and consistency, not on speculation, fear, or the illusion of quick gains. As we reflect on China's current economic situation, one truth becomes evident. Fragility has replaced stability. Slowing growth, soaring debt, a faltering real estate market, and declining consumer confidence signal deep structural challenges. The warning signs are clear, and the potential consequences extend far beyond China's borders. Investors, businesses, and policymakers cannot afford to ignore these realities. Warren Buffett's wisdom offers guidance in times of uncertainty. Economic cycles repeat, markets experience booms and busts, and speculation often masks underlying risk. Throughout history, those who focus on fundamentals, productivity, cash flow, and tangible value emerge stronger than those chasing hype or short-term gains. The principles of patience, discipline, and prudent risk management are timeless, applicable whether the challenge is a collapsed housing market in Japan, a financial crisis in the United States, or a potential economic unraveling in China. Yet even amid crisis, opportunities exist. A careful observer may find undervalued businesses, solid growth markets, or sectors poised to benefit from global shifts. The difference lies in approach. Opportunity is never a license for recklessness. Success comes from measured decisions, grounded in analysis rather than fear or excitement. As we close, consider this. Economies rise and fall, headlines create panic, and speculation promises wealth to the unaware. But true financial security is built quietly, steadily, and deliberately. Recognize the signs, understand the risks, and focus on assets that produce real value over time. China's challenges may reshape markets, but those guided by fundamentals will navigate the storm with their wealth and their peace of mind intact. Remember this final thought. Speculation excites, but value endures. In times of uncertainty, your greatest advantage is not following the crowd. It is understanding the principles that withstand every market cycle.